Welcome to today's Explainer. We are diving straight into a massive three-front battle tearing through the crypto markets right now. The global market cap just took a roughly 3.19% hit, dropping down to $2.16 trillion. And why is this happening? Well, we're seeing an epic, simultaneous collision of macroeconomic anxiety, major regulatory roadblocks, and massive protocol upgrades all hitting at the exact same time. So let's break down exactly what's shifting the landscape today.
All right, let's get right into the absolute carnage. The market just suffered a staggering $615 million wipeout in total liquidations over the last 24 hours alone. When volatility spikes violently like this, highly leveraged traders just get totally forced out, and it creates this cascading shockwave across the entire ecosystem. And this number right here brilliantly illustrates the sheer damage to the bulls. Over 543 million of that wipeout came directly from long positions getting completely blown up. Basically, the vast majority of traders who were betting on an upward breakout, they were caught completely off guard by this sudden, intense downward pressure.
Now, all that pressure has caused some serious technical damage. Bitcoin has officially shattered its crucial $64,000 support level, and right now it's struggling to stabilize in that $63,000 to $63,500 range. What this means for us is that we are in a really precarious spot. Analysts are warning that if Bitcoin can't hold this line, we could be looking at a rapid, unhindered slide straight toward that psychological $60,000 floor. But here's the thing you need to remember. Bitcoin isn't dropping in isolation here. It's being treated strictly as a risk asset today, plummeting right alongside traditional equities. We're looking at a global contagion event, which is really highlighted by a brutal 11% crash in South Korea's Kospi index, along with broader Asian equity sell-offs. Investors everywhere are basically just hitting the panic button on risk. Which brings us to Front 1, the macro boss fight. Just look at how this macroeconomic tension has been building up. We have the absolute weakest labor reading of the entire year, feeding directly into today's ridiculously high-stakes Federal Reserve meeting. U.S. ADP employment change came in at a very soft 15,000. Now, normally that weak data is a dovish signal, and it plays right into Fed Chair Kevin Warsh's upcoming rate decision tomorrow. But despite that weak jobs data, markets are still incredibly tense. Why? Because while holding rates steady is currently favored at 68.5%, there is still a roughly 30% chance that Chair Warsh drops a quarter-point rate hike on us. The market is effectively holding its breath right now, splitting the difference on price until we finally get a clear signal.
So why is everyone so on edge about this? Well, as Bank of America points out, a hike of that magnitude today would be an absolutely unprecedented shock to the system. We haven't seen an intermeeting or consecutive hike like that since 1994. It sets the bar incredibly high for the Fed to actually deviate from a hold. But honestly, just the sheer possibility of it has forced the entire market into this aggressive defensive posture.
Now for Front 2, the regulatory boss. So, the Clarity Act, formerly the Digital Asset Market Clarity Act, was supposed to be this massive regulatory power-up for the whole industry. The goal was to provide actual, clear rules of the road for digital assets by officially dividing market oversight between the SEC and the CFTC, a real game-changer. However, lawmakers have officially pumped the brakes and delayed this highly anticipated bill. With the August recess rapidly approaching, Senate leadership decided to prioritize a Russia sanctions package and federal nominations instead. And that move effectively kills the crypto bill's momentum for the immediate future. As a direct result of this legislative pivot, the polymarket odds for the Clarity Act actually passing into law in 2026 have completely plummeted to a dismal 37%. The market was eagerly pricing in regulatory certainty, and poof, now that timeline has just evaporated. And this regulatory delay is absolutely crushing altcoins right now. Without clear rules, capital is fleeing those riskier assets and concentrating heavily back into Bitcoin. Market breadth is just incredibly weak. I mean, only 29 of the top 100 coins are currently trading above their 50-day moving average. When you combine that with massive liquidity pressures on the horizon, like a huge $415 million token unstaking for Hyperliquid coming up, it is an incredibly tough environment for alts. Moving on to Front 3, protocol power-ups and the resistance. Because the crypto ecosystem isn't just sitting there taking hits. The underlying technology is actively charging up its own defenses. Lido, the largest liquid staking protocol, just deployed its colossal curated module v2 upgrade. This is their biggest shift since 2023, consolidating roughly $16.5 billion in staked Ethereum value. And it completely overhauls validator accountability by requiring curated node operators to post locked ETH bonds for the very first time. And this massive consolidation, it's powered by a brilliant technical leap known as 0x02 withdrawal credentials. Previously, a validator was strictly capped at 32 ETH, but now a single validator can hold up to 2,048 ETH. That is a 64x increase. Lido models that this newfound efficiency could slash the total Ethereum validator count by 1/3, which would drastically ease the processing load on the network's consensus layer. At the same time, we're seeing some heavy institutional armor getting equipped in the background. BlackRock's ETF absorbed over $200 million in inflows yesterday, clearly stepping in to buy the dip. Furthermore, Securitize officially registered as an SEC investment advisor. This is a massive structural win that bridges the gap between traditional, regulated finance and on-chain infrastructure for real-world assets. So we're left with this epic split-screen showdown. On the bullish side, we have deep structural protocol upgrades and major institutional registrations. But battling head-to-head against them are some serious short-term sentiment dampers. For instance, Elon Musk's newly launched X Money chose to ignore crypto entirely in favor of fiat. And at the same time, the NFL is actively pushing the CFTC for stricter oversight of sports prediction markets. Which leads us to the ultimate question. What's next for crypto? Right now, collective psychology has sharply retreated. The crypto fear and greed index has dropped to 29, placing us firmly, no question about it, in fear territory. This directly reflects the breakdown in momentum we've seen on the charts. It's sparking profit-taking and a highly visible flight of capital as investors seek the safety of stablecoins. Ultimately, all eyes are completely locked on the Federal Reserve. The fundamental technology in this space is improving rapidly, but make no mistake, the macro environment is pulling the strings today. When the dust finally settles tomorrow, will Chair Warsh's rate decision unleash the bears for an even deeper correction, or will it trigger the ultimate relief rally? Keep your eyes on the data, and we'll see you in the next explainer.